As a student of financial reporting or audit within ACCA, you already know that the profit figures of a company within statement of profit and loss are very important. Although we understand that based upon the profits, there are a lot of decisions made by the stakeholders of the company. But essentially, these profit figures are also very important for the directors of the company. Essentially, because their bonuses are based upon these profit figures. Because of this, there is always this incentive present for the directors to try to increase the profit somehow, so their bonuses would also increase. They could either overstate the revenues or understate the expenses in order to get a higher profit figure for the company and essentially get more bonuses. And as a tutor of audit, I always try to explain that this incentive of overstatement of revenue and understatement of expenses is very important for you. Now, all of this information which I've given to you is related with the UK's retail giant known as Tesco. The directors of Tesco had their bonuses linked with the profit figures of the company. And how would they achieve it? They used to understate the expenses in order to gain a higher profit figure so that they could get more bonuses. The question is, how would they do it? The suppliers of Tesco used to give them discounts based upon the amount of quantity that they are going to purchase. So essentially, higher the quantity that Tesco would purchase from their suppliers, the discount would also increase. Now, what the directors used to do is that even for the future purchases they were going to make, they still would record the discounts that they would receive in the future. Meaning that they did not actually purchase anything at the moment, but still they would record the discounts within their expenses. This would reduce their expenses and hence the profits would increase. In the case of Tesco, the auditor PwC was never able to identify these issues within the financial statements. They would straightforward rely upon the management's estimates, the discounts that they were recording. They would agree with the management. This issue was raised by the finance associate of Tesco to their new CEO in 2014. And only after this issue was raised by someone, then the auditors came into play and identified that there was a big issue within the financial statements. Now, as a student of audit, this example also teaches you why it is important to not simply rely upon things that management is sharing with you, why appropriate testing is to be performed upon it, and why professional skepticism is important. Thank you.